Hi guys, thank you for attending. And yeah, my session is going to be sharing about VC funding, the benefits of it, and I hope you guys can learn something from it. So yeah, just to give a brief background about who we are and what we do at MAVCAP. So we were actually here around 2001, and we were mandated by the government to provide funding to support growth of Malaysian startups and build the ecosystem. So through that, we have a couple mandates that we follow, which is 6. First is we want to develop the local VC talents, which is like people like me. I started as an intern, and then I gradually worked my way up to be an investment associate. And the second is that we want to spur local VC ecosystem. That means we want to bring in more funds so that people have more money to invest in. And third is that attract private partnerships. So how we work is that we are a fund of funds. We bring in investors from overseas. Like let's say we have our partners such as 500 startups, Gobi partners. We bring these guys in and say that, hey, we'll be your first check into your VC fund. What you do is you go out and you get other investors and you come bring the investments to Malaysia. You set up your headquarters, like Gobi is set up in our office. If you can see, Capital is also set up in our office. We try to gather as much investments within the region. So fourth is we create bigger pools of funds. So by grabbing the VCs into the area, we get to have more activity and then more investments, and it will look lucrative to outside investors. So fifth is bringing in foreign technologies, and the last is supporting local VC infrastructure through like attending events, hosting events. So yeah. So this is just I'm just gonna breeze through it just to show who we are. We facilitated 2 global VC firms entry into Southeast Asia. So if you can see, 500 Startups was actually from Silicon Valley, and Gobi Partners is from China. So we told them, hey, if you come in here, we'll be your anchor investor, and we would put the first check in you, and we'll follow on through the other checks. And we gave birth to 3 local VC firms, which is Interest, Capital, and Ficus. And we supported 3 regional VC firms. Lunex is from Singapore, Kejora is from Indonesia, and the last one, The Flower, is from AGF, which is from Hong Kong. So yeah, these are just a couple of the stats that we have. 2.2 total billion total funds made accessible, and we've had 14 ongoing funds so far. And here are some unicorns within our portfolio: Bukalapak, Grab, Kasem, Carousel, Airwallex, and we're also very excited about the unicorns in our funds portfolio, which is Policy Street, Easy Parcel from Penang, Mind Valley, Janexu, and yeah. So yeah, I know just now we've been having a lot of talks about venture capital, but this is just also a quick overview about venture capital, just to refresh in everyone's head. So venture capital, what is it? It is equity investments into earlier stage businesses that require capital. So if you look on the graph on the right, you can see that we typically take investments from seed all the way to later stage. So normal and most VCs exit during IPO and public markets. Those we don't touch. We normally touch the earlier stage where the cash flow is really low and it's extremely high risk. So there are only 2 reasons why we would fund these, we will provide these kind of equity investments. First is to scale your existing business. If let's say you have a customer base of 100 people and think you have product market fit already, and if you just crank the engine, you can bring it to the next stage. Yes, we provide funding for that. The second is to support the development of new products. Let's say you have a SaaS service, accounting software. You want to do more than accounting. You think you can go into HR at the same time. You can go into earned wage access. Yes, we provide funding for those kind of services. And VC funding is not for all businesses, just to be clear. It's only mostly for tech startups. So how we do define a lot of tech startups is that, if you can see in the column, negative cash flow earnings. We understand that businesses lose, startup businesses lose money in the first place. High burn rates. I mean, tech talents are extremely expensive. You know, you can't just simply hire. You have people like all the FANG businesses, they are scooping up people, everyone's going overseas or to Singapore. It's very expensive. So capital intensive R&D, you want to develop your product, you need a lot of money for that. We can provide equity investments, and typically companies like these have a lot of intangible assets, a lot of IP, software, and last is absence of a proven track record. Why we say this is because VCs typically take risks that banks won't take, you know, and they provide enough big of a funding that they will make an impact, because you can go to angel investors and friends and family, but the amount of capital that can be obtained through there would be a bit smaller as compared to what a VC will be able to provide. So yeah, so there's two graphs. One is the potential return to risk, and next is returns that are going back to the investors. So if you look at here, it actually says that research shows that out of 10 investments, 6 will lose the VC investor money. So you're thinking, how does that even make sense? Out of 10 investments, how can you, let's say you put 1 million each, so altogether 10 million, you lose 6 million. How are you going to make back your money from 4 million? So VCs normally look at the power law. What that means is 20% of your investments will make back the whole fund. So if you see this chart right here, investments that will make you less than 1x your return is going to be over 50 to 60%. So like I said, 2/3 lose money. And 1 to 3x will be typically 20, I would say 20 to 30%. Given this, I would say market, it will be even lower than that. And if you go up the scale, those that can actually return you more than 10x or 20x is very, very small. That's why VCs always have to look at the market size in terms of, they're already taking such high risk, but they need to make sure that the risk is a risk well taken. Next. And lastly, I'm also going to explain a bit about how it works and how we provide value. Because investing is only the first part of the VC's cycle. We have all the way to monetization. So if you want to start with the first process, it's actually we find startups through deal sourcing. So deal sourcing common methods are attending demo days, searching online, getting referral from friends, and through the network. So that's what I call the funnel part. You know, you go and engage with people, you talk to people. So after that, we do our own due diligence. We have a bit of we take a first meeting with you guys, and then if let's say we come to a conclusion and our IC, which is investment committee, says that yes, your startup is good to invest, so we will offer you guys a term sheet and then invest. So thirdly, after the investment, some VCs, depending on what their area of expertise would be, they would add value by fostering collaboration. So I can give you one very easy example. In our portfolio company, there's a VC called Vin Capital. So what they did was that once they invested in Droppy, which is I think it was a procurement company, they helped them synergize collaborate with other funds in their portfolio. So they had Casem, Travelio, and they helped Droppy work with these guys, since they're already invested, to generate more value. Because at the end of the day, we have aligned incentives. When we invest in your company, we want to help it grow at the same time. Because if our stake in you grows, we benefit and you benefit too. So fourth is that reinvest. So in a fund, let's say, and I'll give you a very quick example of $100 million fund. Some people, when they make their investment decision, they would think that, okay, 50% of the fund I would use for first investments. Another 50% of the fund, I would double down on my first investment. So let's say out of a portfolio of like 10 companies, 3 are doing really extremely well, and they need to move on to the later stages, and they need funding. So depending on the VC's fund size and what you call dry powder, which is money left from their first investments, they will typically double down and increase their stake, because they see that, hey, this is basically a rocket ship. The valuation is going to be high and I can see where it's going. Let me tag on so that I would have more stake as it goes on. So at the end, my investments will be bigger than just that small initial seed size stake. So fifth is to grow. So like I said, in an investment timeline of a VC fund, you must understand that it's normally 10 years. First 3 to 4 years is investments. This is when we do step 1 and 2 mostly. You know, we have a timeline. So they have to invest. They have a mandate. If they don't invest, there will be penalties. So yeah, that's why you see a lot of what happened last year with SoftBank and everything. They had a big fund. Every month they needed to deploy 2 billion of capital into the markets. That's why you see how it was so, the valuations were so bumped up, and it's actually because they never set their fund life longer. They set into 10 years, so that means that first 3 to 4 years, they have to deploy. And 5 to 6 years, this is when the harvesting comes. So we've seen from our fund, it typically takes around 3 to 9 years for the harvesting, which is growing the fund. So this is when we help you scale, we help you build revenue, and yeah. The last stage is the monetization event. So VC, they need to appease their LPs too. They have a bunch of investors behind them saying that, hey, we give you this money, 10 to 12 years, please provide us back our returns. So this, how do they provide their returns? In a couple ways. First, M&A, mergers and acquisition. You get acquired by maybe a bigger tech player wanting to come to the space. Let's say, my example before, accounting software. Maybe a big conglomerate accounting software from Europe wants to come into Malaysia. What will they do? They don't want to start scaling here. They don't know anything about the market. They typically would just buy out firms so that they get the user base and they can integrate it into their system. So that's one point of acquisitions. Second is that you can do a secondary sale. This is more on the investor side. So any new investors want to come on board, I sell my stake to them instead so that they can come in at a slightly more discounted stake. Thirdly, I think you guys all know IPO. You can IPO in Bursa, you can IPO in NASDAQ. I think there's a lot of places you can IPO. Tokyo, you can IPO, and it depends on your, whether they know you in the market and whether the demand for you is good. Yeah. So this is kind of the timeline, which takes around 10 to 12 years. So next is benefits of venture capital funding. This is where we come into why take venture capital funding. So there's a couple. I will split it into 2 sections. One is the short-term advantage, and another is the long-term advantage. Short-term advantage, anyone knows that once you get money, you can scale your business immediately. Accelerated growth, that large amount of capital, once it comes into your business, you can start hiring, you can start marketing, all that. So these are the other 3 long-term advantages that may not be so clear. So increased network access. This is very dependent on the type of VCs you get aligned with. So some VCs, they have particular resources just based for maybe fintech firms or like supply chain firms. So you need to know your VCs. So increase access into venture capital resources such as mentorship, finances, and their network at the same time. Next is you get increased publicity and exposure. Great VCs can help you be more credible. I'm sure you heard before that, you know, if a good VC invests in you, the next VC that comes in, they would take this as a signal that says that, hey, this guy has done his due diligence on you, and he thinks that you're credible enough to invest his money into it. So therefore, I would take it as a good signal. I would not invest purely based on that signal, but it's one of the check marks. It's like a green light up. And third is signaling to future investors, we just talked about. So on terms of accelerated growth, there's also 3. Sizable amounts of capitals can be raised. I mean, all the way, as you heard, 50K all the way to 100 million. Those are big rounds that can be raised with venture capital. Second is repayments are not required. So unlike debt, you know, that can put a dent in your working capital and even give you more pressure because every month it contributes to your burn rate. You will have extremely high burn rate for a younger startup. You know, let's say you're maybe seed or Series A, those are not going to be favorable terms when you come to fundraise or to, because even, here's one thing about debt, right? If you take debt during the initial phases of your startup, yes, it's okay because you don't lose equity, but at the same time, if investors come in at the later round, I've seen this in some of the firms, some of their money is going to be used to repay the debt. And investors don't like that. Let's say I invest 2 million in you, 1 million is going to pay the debtors, and then 1 million is going to you. So it's not going to be a good deal for me. So you must be very careful when you take debt. So typically you see a lot of debt players come in at the later rounds where they have a strong source of revenue, they can split it evenly, and it's less pressure on the firm itself. And last one is follow-on funding. There's tendency for startups to raise venture capital funding several times. And even, let's say you get into one investor, you need follow-on funding. The investor also has their investor friends that they would pitch it to, like, hey, I have this startup, really great traction, I trust them, do you want to come in the second round? Stuff like that can happen. So in terms of network access, you get access into mentorship, finances, network. Why do you get these access? It's because you have aligned incentive. VC investors have a common shared goal with the founders to maximize the value of the startup. So this aligned incentive also comes at a price. So the more equity you give an investor, the more aligned your values will be. So for example, very easy, let's take Mark Cuban from Shark Tank. If you pitch a product on Shark Tank, he invests in your company, let's say 30% stake and 2% stake. Same company, same field, not same company, same field, maybe you're both selling, the scrub daddy, the sponge, stuff like that. So when, let's say in future, if there's a problem, same time between both of you guys, and maybe there's a solution where only one startup can take, which one do you think he will be inclined to help most using common sense? It will probably be the 30% stake because he has more time, he has more equity sunk into it. That's why he has more incentives. So yeah, you can guard your equity, but make sure you give it to the right people that can help you scale your business. If not, it's going to be bad for you. Because money at the end of the day is not free. It may seem free, you're getting equity, but at the end of the day, they need a return and you need to deliver that return. And thirdly, increase publicity and exposure. So like I said, you get to tap in the investor's credibility. So let's say Sequoia invests in you. From now on, you're not just going to be startup A, you're going to be startup A that Sequoia invested. Or if you join YC, why a lot of people like to put in their startup YC behind is because they can tap on that. This is a lucrative club of startup companies. Not everyone can get, and I got into it, and therefore it kind of reflects on me, on the quality of startup I have. And second is also a help to brand awareness. Some VC firms might have connections with Tech in Asia, Deal Street Asia. It can get you into all this publicity and press. So last point I want to make is that investment dollars also signals to future investors. So not all VC dollars are made the same. If you get investment from Sequoia, maybe Wavemaker, like I just want to reiterate that it's a signal. It's a signal to investors that your startup is good. So it serves as not only better investor, but better opportunity kind of stake, but it's also a door opener so that when you want to pitch a startup the next time, it's going to be easier for you. So I just want to leave with this. Here are 5 questions you should ask yourself, before you meet an investor. Are you open to more active input from a venture capital firm, from this venture capital firm? Second, do you appreciate the additional expertise and resources a VC firm could provide? Let's say it's a fintech startup. Do you appreciate that? Do you want their connections and network? Or maybe if you don't want them. So if you don't want them, then maybe you don't actually need such a firm. You can go with another firm. Someone with, expertise that you might need. Third, is loss of ownership and control an issue for you? Fourth, could you gain through a VC firm's business connection? And the last one, the most important one actually, is does this venture firm, capital firm's end goal align with what you want for your startup? At the end of the day, you're going to work with these venture capital firms for quite a long time, 3 to 5 years. If you don't get invested by the right people, it can be very detrimental to your business. They could give you really, really bad terms, and it could ride with you the rest of your fund's life. So you must be really sure that you know what's the VC's vision for your company. So yeah, thank you very much.